Hi, this is James Eng with Full Capital, and today's January 2024 webinar I'm titling Frozen. So a lot of people got back from their winter break, and like this was the front of my house yesterday. So just completely covered in a little bit of snow. That's a lot of snow for people in Dallas, and so the past couple of days have been quite cold here in Dallas and across the nation, and so I thought it was applicable to talk about sort of what we're seeing in today's market and go with the theme of Frozen. So um, this month's agenda, we're going to talk about sort of leverage in different ways, the Fed, interest rates, and then this Q4 2023. I went back and looked at sort of the last quarter and pulled out some transactions that I thought we should highlight and sort of how they got done and then wrap up with some of the market forecasts for 2024 by different segments. So the major markets in Texas, and then also talk about the financing world out there. So let's jump in. So this was actually Andrew Cushman had this on, I think, LinkedIn. He had maybe got it from a broker. And I thought it showed the last 3 years and sort of where cap rates were and where interest rates were, and I think this was maybe for one market, but essentially, nowadays everything's the same market, it seems like. So cap rates in red. And so you had a huge spread between cap rates and interest rates. And then pretty much sort of Q4 2021, they intersect. And then now it seems like cap rates are trying to catch up to the interest rates, right? So interest rates have just gone on a tear since the Fed started hiking. And I sort of added some notes over here. Before we get into notes, I mean, so when you were buying in 2020, sort of right during COVID, you had plenty of positive leverage, right? So your interest rate was 3%, your cap rate was 5, you had plenty of gap there. And then neutral leverage really took over sort of 2021 to 2022. And then really in starting in end of 22 to 23, you had negative leverage where your interest rate was higher than your cap rate. And so that's why a lot of deals haven't been able to go because buyers have been sort of stuck up here. So let's use this example: $1 million NOI, you can get about $11 million loan at 6% interest. So buyers want to be right. Obviously, they would want to be at 6.5 to 7, but buyers are willing to pay sort of this 1 million at 6%. So that gets you to 16.7 million, which is about 66% LTV. And sellers are sort of still stuck down here, right? So this is where deals are trading at sort of this 525 level. So 19 million. So there's $2.3 million gap on this deal, which is 10-15%. And so there's still that gap. And so we saw a lot of deals who came out in 2023 and they went through all the call for offers, they went through all the tours, and they didn't go because the buyer's price was just too low, and sellers just said, "Well, we'll bring it out next year." And so we didn't see a lot of deals actually trade in 2023. And so you can see here's some reports from Yardi. It goes through Q3 2023, but I mean, you can look at these quarterly volumes of sales and they're pretty light, right? I mean, Q4 of 2021, just that one quarter was bigger than the entire 2023 year. So Q4, I think, would be probably right in line, probably with Q2. So I think once they see the final numbers, but 2023, that transaction volume was down about 70% across the board. So depending on who you talk to. And then on the lending side, I mean, 2023, here you've got CMBS, agency, and CLO. And you can see that that's in the last 10 years, that was the lowest lending volume as well. And so lenders are more cautious, borrowers are being more cautious. And so just the overall lending environment was down year over year significantly. All right. So what is going to sort of break this up and what are people looking at right now? So the thing that came out really at the middle of December was really the Fed coming out and saying, all right, here's our goal of 2%. We see inflation coming down, and their dot plot basically came out and said, yeah, we're going to start cutting. And so they had, I think, 3 cuts in 2024. And so here on the very bottom, you can see sort of They're at 5.4, 4.6, and then 3.6 by the end of 2025. And so, that was welcome relief to a lot of people. November was tough when the 10-year hit five, and now it's come down. But this sort of nobody knows when they're going to cut, but just them coming out and saying it gave a lot of relief to a lot of people. So you can see this is sort of the dot plot forecasted. So you can see that it's going to be, sort of 425, um, and then potentially lower, even hitting 350, 375 is what the market is saying. So the Fed dot plot sort of ends at sort of that 425, but the market has projected getting close to 4% on SOFR. But even going from 5 to 4 still doesn't help a lot of people, especially on interest rate caps. So usually on interest rate caps, you're buying in that 2 to 3% strike range because your spread on top of that is typically 3 to 4%. And so the interest rate caps still haven't come down. This is really like you're just prepaying interest right up front. But I would say the 3-year stuff has come down a little bit. This probably used to be 6 or 7%. Now it's closer to 5% to buy your 3-year caps on the federal funds. So this is what I was talking about on the 10-year Treasury. I mean, November was just really painful at the beginning of November, hit almost 5%. And now it's come back down to closer to, I think it got down to 3.8, 3.9. And then it's popped up. It's been around 4% the last 2 or 3 weeks, though, in that range. And so that's given people need to see a stabilization on that 10-year Treasury. But yeah, I mean, this at 5%, nothing was getting done. But a lot of people were comfortable when 10-year hit around 4, and at the end of December, we saw a lot of deals sort of lock their rate and just sort of move on at that point. And so, besides the capital markets, what are people seeing out there? I mean, this is probably the most aggressive or highest new supply number that I saw on a chart. 2023 had about 439,000 units. And then 2024, this is from RealPage, they're expecting 671,000 units to complete. And, that's, when you see a lot of properties that were built sort of in the 80s because of where the tax laws and everything were. And that was, 500, didn't cross over to 600,000. So we see a lot of new supply coming in 24, and that is definitely going to put a damper on rent growth this coming year. And a lot of people are asking, like, why is so much new supply coming on? A lot of people who couldn't buy in 21 or 22, the value add deals with a bridge loan, they said, well, I'll just build it. And so it takes about 2 to 3 years to build it, and then you got to lease it up. And so all that is coming online right now. And so, the only sort of saving grace after this one is really that financing is so expensive on new deals that not a lot of starts are happening. And so, I think the original quote was survive to 25, but it might be 26 because there's going to be so much delivering in 24 that it's going to have to lease up, and that's going to take 12 to 18 months. And so it might not be until 26 where you're going to see that strong rent growth come through. In terms of rent growth right now, probably the last 6 months have been pretty flat, a little bit of a downturn overall. So overall rent growth was about 0.3% across the nation, and that was the weakest since 2010 when it was only 0.2%. So rent growth is definitely going to be soft here for the next, it might be 6 to 12 months. Okay, so what are we seeing in sort of transaction data out there? So here's a couple of highlights from Q4. And, the first thing I would highlight is, on the deals that did close, it was really Fannie and Freddie deals to get them closed. And then it was 5 and 7 year loans. So here's just a snapshot. I just pulled, this is based on Texas data. Deals that closed in Q4 and sort of what their loan duration was. And you can see, in the past, it was really 7 and 10 year money. A lot of people are shortening that up, going to 5 and 7 year money right now, just to avoid sort of a larger yield maintenance penalty if these interest rates drop. So you can see some of the interest rates that are shown here. It ranges, 575 to 625 in that range. across the board on fixed rate stuff. And so if you're looking for this type of data, feel free to reach out to me, and we can maybe run it by a market and see sort of who's closing in those markets out there. But okay, so we went through in terms of how people were putting these deals together. But it was also interesting to see sort of a reset basis. So when I started in 2015, all I really saw was loan amounts increasing and values increasing. And so now we're seeing a reset basis where people bought these deals in 2019 and they put a $24 million loan. This looks like it was a floating rate loan. And now the next guy buying the deal is coming in with a lower loan amount. And so, Texas is a non-disclosure state. And so you don't know the exact purchase price. But a lot of times these deals are probably 60 to 65% levered. So you can sort of back into the purchase price. And on a majority of these deals with the reset basis, these prices are coming down. And so we see it here on this deal when people went to Fannie Mae. Um, this one in November, this was a loan of 19.7 million done in 2019, and now the new loan is 15.2. So these deals were in Houston. Here's some deals in DFW that I'm a little bit more familiar with, but this was a bridge loan at 35, and now the second bridge loan is at 28. A couple of years later, same thing with this deal, $31 million bridge, and then this one's a 25. So that delta between the amount that the bridge lender is giving you, a lot of times that's just the equity that the prior seller, when they bought in 21, is essentially losing. On a lot of these deals, it is not eating into the loan amount quite yet, maybe a little bit, but a lot of this is the equity. And so this was the last deal sort of purchased in 2021, $9 million bridge loan, $6.6 million agency loan that was put on at the end of 2023. So a lot of agency loans, reset basis on a lot of deals, whether it's probably 20, 25% from the 21 peak. And then, we're starting to see some foreclosures. This is sort of a notice of acceleration, which, to me, this is they posted for foreclosure, and then maybe they're able to, pay back the interest, and it actually doesn't sell. So we've seen some deals where lenders have posted the deal for foreclosure, but they actually don't get sold. Other times, other people, they just run out of money and they end up getting foreclosed. And so we've seen a couple deals that have actually gone. This one was a Freddie. This one looks like it's a floating rate loan, and these guys couldn't make the payment anymore, whether it's the interest rate cap or the occupancy. And this one was a bridge loan. And so we're starting to see some foreclosures trickle through where deals cannot be worked out between the borrower and the lender. But some of these deals are getting done, whether it's bridge to agency. So this was a bridge loan at 40 million, the agency loan's at 42. So whether this deal was done at lower leverage at the time, or they were able to implement their business plan and sort of achieve sort of the net rental and the NOI that was necessary to refinance this deal. This one went from 40 to 42. So no money needed on this one. Some deals are just getting redone either by the same lender, sort of bridge to bridge. So giving people a little bit more time on these deals. And this one actually went from 76 to 83. So they were able to get a little bit more loan proceeds and get a little bit more time. But I mean, I think this is going to be more of the standard for 2024 is you're going to have to bring in more equity on these deals. So you're going from a bridge to Freddie. This was a $6 million pay down. This one was a $4.5 million pay down. This was a $4 million pay down. So as you go from these bridge loans or these floating rate loans into fixed rate loans, you're going to need to bring more equity to get them done. All right, so this one I thought was we had not seen as many of these, but this one was going from Fannie and Freddie over to CMBS, and so CMBS typically carries a higher interest rate. So if Fannie and Freddie are in the 575 to 625 range, this was closer to 7 at the time, and then this one was a cash out, and so sometimes whether there's an issue with the property or an issue with the borrower, maybe the occupancy doesn't hit. So Fannie and Freddie required 90% occupancy. These look to be about, mid 80s. And so sometimes it's just time to go. And people, whether it's acquisition or refinance, they cannot buy or they don't want to use a bridge loan, they'll use CMBS. And so on this particular property, it did go CMBS in terms of a cash out refinance. So they were able to get some cash out, return of equity back to the borrower on this deal. All right, so that's sort of what we saw sort of historically, and now looking forward, this comes from Berkadia. This was some of their market updates, and I thought it was interesting just to look across the four major metros in Texas and seeing what the predictions are out there. So almost all of these, there's big deliveries. Whether this absorption happens or not is the biggest question, and that's going to drive sort of your occupancy across the board. And then, most of these cap rates, so Austin has it got down to 3.5% cap rate and now about 5.1. But price per door, they're predicting about 180 a door in Austin. In Dallas, cap rates, they have about 4% and then moving up to 5.5%. But, I would say that the difference between Austin and DFW is DFW probably has about 2 or 3 times the amount of units that Austin has. And so, but the amount of construction is still pretty high, but as a percentage, DFW is not as high, and absorption's probably a little bit stronger in DFW. Houston, a little bit lighter on supply, but not as much absorption. They're expecting cap rates about 5.5%. Down in Houston, 128 a door. Down in Houston, really, I think, insurance is hitting this, and then also just overall occupancy is a little bit lower in Houston compared to DFW in Austin. And then let's round out with San Antonio. So highest cap rates are in San Antonio, 5.6%, 122 a door. And this looks to be the only market, supply is pretty light, and they're expecting absorption to be higher than the deliveries. And especially that sort of San Antonio to Austin corridor that everyone's been talking about for that I-35 corridor for a while now. So, all right. So what's going to cause all this ice and snow? This was just in the afternoon. So snow doesn't last that long in DFW. What's going to cause the thawing out on this frozen market? And to me, it's maturities, right? So as these loans mature, this is just in 2024, I just pulled, all right, what's the maturities in Texas coming up? There's 155,000 units coming up. So, people are going to have to move, and they're going to have to refinance, put more money in the deal, or they're just going to sell at a loss and move on and focus on new deals or the existing portfolio. And so, if you want to see this list, I mean, this was a big hit last month, but if you want to see this list of upcoming maturities, I ran it for Texas. If you want to run it for a couple other markets, let me know. But send me an email down here and talk to me about the markets that you're looking at going into. And if you need help with an upcoming loan maturity, what we're doing right now is sort of 15th of the month, we reach out to all the people who have floating rate loans and talk to them about and say sort of what is that gap, because you have to be in position if 10-year Treasury drops to rate lock. And a lot of times, that's 10 or 15,000 to get the third parties done and to be in position to rate lock these deals at the lower number. As we see, Treasuries could move 10 or 15 basis points in one day. All right. So my background, born and raised in Houston, went to school in Austin and then been in DFW since 2006. Was an underwriter for a long time, 07 to 15, and then spent the last since 15 really focusing on multifamily loans and then investing in a lot of properties all throughout Texas as well. So here, in terms of what we're seeing on the financing side right now, we got your bank loan, Freddie SBL, and then your agency loans, and then your bridge. I mean, obviously, a lot of people are sticking sort of in this middle section right now in terms of Freddie and Fannie. And so let's talk about each individual one. On the bank side, a lot of people are still asking for development loans, and those are still hard to come by. They're really focusing on people who have existing relationships with local and regional banks. And this is really smaller deals. So on smaller deals, Fannie and Freddie are typically having an adder on there. And so it makes those deals a little bit more expensive to get done, especially in secondary, tertiary markets. And so some people are still using bank loans in that 8 to 9% range. Freddie Mac SBL, this has been sort of a steady mover. It used to be a little bit behind Fannie in terms of updating rates, but just with the amount of volatility, they've essentially moved their rates as fast as the markets move. So if the market moves 10 basis points down, they usually update their rates pretty quickly. But then once you lock in your rate and you sign the loan application, it is held for you as long as you get the deal into Freddie in a decent amount of time. But we just closed this loan in the fourth quarter. Freddie Mac SBL 10-year term, 3 years IO with step down prepay, and it was a fixed interest rate throughout the process. So that puts a lot of the interest rate risk, takes a lot of that off the table for buyers because you know exactly the interest rate you're going to get. Freddie Mac conventional, we're seeing a lot of people. This was a deal, quarters at Town Oaks, that we closed. It was a floating rate Freddie. They wanted to just move to a fixed rate, get off the interest rate cap escrow, sell the rate cap, get all the money back, and sort of reset the deal. And a lot of people are able to get higher leverage right now on acquisitions as well, especially on B and C stuff as cap rates get up higher and interest rates come down. And this was Fannie Mae. Fannie Mae is still very active, as we saw on that list. More 5 and 7 year deals getting done right now. But this was a deal that we closed in Euless. Fannie 10-year term, full term IO, fixed rate. So Fannie is still very active. Freddie and Fannie didn't hit their caps in 2023, and they got about 70 billion, I think, in 2024 for their caps, each of them. And most people, everyone's hoping they hit their cap because that means the year did pretty well. But we'll have to wait and see if they hit their cap. And then in terms of non-recourse bridge, I mean, we're still seeing, especially, I would say, larger deals, 30, 40, $50 million and up. People are still doing bridge. People are still doing buying the cap, and they're doing it more as an insurance policy, and they're buying it, and they want that flexibility on the exit, and they are typically buying pretty tight strikes, so in that 1 to 2% range, to get an all-in rate about 5 to 6% throughout the process. So in 2023, Old Capital closed about 540 million in loans, and then it was about 5,500 units. And you can see majority of the deals were Fannie, Freddie, some HUD refinances, a couple non-recourse bridges, but majority of it was agency loans throughout Texas. And then, in terms of working with us here at Old Capital, I mean, whether it's Fannie, Freddie, whether it's bridge, we do all those parts, all those different loans in the market. But then, whether it's our podcasts, our speaker series, or lunch and learns, webinars like this is where people get educated, and we really help you throughout the process. Whether it's touring deals, me and second set of eyes on the entire loan process, and making sure you're buying deals that make sense and are in the right areas. So a couple upcoming events. These are coming up quick. So if you're watching this, it might be a little bit late, but JP Conklin, Pensford is coming in and speaking with us this Wednesday, January 17th. And then also we are doing a little field trip, DFW field trip, with I think about 50 investors. We got one bus, and we're gonna go take them around some of the properties that we have financed. And so if you missed this one, maybe there'll be a next one. Send me an email, and we'll try to get you on the next one. In terms of next steps, definitely subscribe to the channel to keep up to date on the latest webinars, and then also like and comment below with sort of what you're seeing out there. And then if you need help with upcoming loan maturities, you can send those to me, or just a new deal, right? So in terms of acquisitions, and then, really to get started, we ask people to set up time with us to go through their personal financial statement. And then if you're looking at joining Old Capital or sort of a mortgage broker, look at us and send me an email with your resume. And so I appreciate you guys listening and watching, and see you next month.